in the private markets in a meaningful way. And the MD and CEO of Motilal Oswal Private Wealth, Ashish Shanker, joins in on the show today. Ashish, it's been a long time. Thank you so much for taking the time out and being with us today.
Pleasure, Neeraj. Happy to be with you.
Yep. Thank you so much, Ashish. I'm sure private markets have seen a slowdown both in activity and in terms of transactions. How sharp has that been? And are the reasons predominantly the risk-off mode, or is there something else too?
I think, Neeraj, more and more family offices are actually getting organized in their private market investing. I mean, we saw a rampant spate of activity about a couple of years back when markets were buoyant. And slowly the family offices are getting more disciplined about their allocations, where they are going either through a fund route and then going through the co-investment route once they have access to the deals of a particular private equity fund. There has definitely been a slowdown in the recent past, and the reason for that is, typically why would one go to private markets? And they would go to private markets because they are getting themes that are not available in the public market, point number one. Point number two, private markets offer you a valuation advantage. I mean, typically these deals come at a slight discount to listed markets. And at the same time, you see higher growth because these are emerging sectors. Now, with valuations correcting in the public markets, the private markets take a little longer for the valuations to correct. They're not listed, and hence there is no price tick on a daily basis. So that's one of the reasons for a little bit of a slowdown, and investors are also in a wait and watch mode to see how this entire situation pans out.
Got it. Okay, Ashish, so is the net outcome of this that private markets have been transactions and interest is relatively insulated from the public market meltdown? Or are you saying that yes, this has happened, that even those have slowed down, but they will bounce back as the public markets do, simply because the interest levels are now fairly high? What is it that you're trying to say?
So it's not necessarily insulated, Neeraj. I mean, the similar emotions go on even when you're investing in private markets, and obviously public markets are the barometer for valuations again in private markets. However, private markets have a slightly longer cycle. I would say in no way that the attraction of private markets is over, but I think the cycles in private markets are longer. So for example, if let's say as a fund, I had made a commitment maybe 3-4 months back. Now on the ground situation has changed, but it takes about 3 to 4 months for me to go through the due diligence of that particular asset. But I still have to honor the commitment that I've made. So private markets have slightly longer cycles in terms of investing as well as exit. So whatever you're seeing right now is just a temporary blip. I mean, you will see more and more activity in the private markets as things settle down.
Ashish, good morning. Hiral on this side. Let's link the private markets to what's happening on the private credit side as well, because in India, from what I was reading, we are growing at 35%, and this was data back in 2024. Returns of around 12 to 18% is what we've seen from there on. Now, if you have to look at what's happening to private credit in global markets where redemption is becoming a pressure point, how are you seeing that contagion impact coming to Indian markets as well, if you have to link both the sides?
So if you look at private credit, I mean, it's been growing anywhere between 30 to 35% in India. And we are seeing more and more allocations from global investors as well as family offices in India towards private credit, because it offers a fairly attractive asset in the region of 12 to 18%. See, what's happening globally is very different. And if you see a lot of these stress points that are emerging globally in private credit are coming in the tech sector. However, in India, given the tight regulations by the central banker for banks, a lot of the credit which is opportunistic or required from time to time for corporates or probably at the promoter holdco cannot be made available by banks. And that is the kind of credit market that the private credit funds are catering to. So I would not link the global stress to what's happening in India. In fact, we've seen very, very robust inflows into the private credit ecosystem. I mean, even our house just did a first close of our private equity credit fund at 1,700 crores, and we could raise this money in barely 1.5 months. So it offers a fairly attractive opportunity for domestic investors to get higher yields with very strong governance, structures, and underwriting.
Ashish, one final question therefore, at least from my end, right? Which sectors will see the highest interest, you reckon, are seeing and will see the highest interest over the course of the next 9 months? In the public markets, as you would also know, but just for saying for the benefit of our viewers, there has been a bit of a change, right? Energy and energy transition has come in, but even energy exploration has now become a real theme. Data centers, a very real theme. Defense has actually gotten activated even more interest, right? You would see similar trends on the private side, or is there something else that gets added?
So in the on the private side, see, look, there are three asset classes on the private side. You have private equity, you have private credit,
right,
and let's say you have real assets. Okay. Now, in private equity, a lot of the emerging sectors. See, think of it this way. I mean, India is going from a $4 trillion economy to a $10 trillion economy, let's say, in the next 10 years. Now, a lot of the sectors which are actually growing very, very fast are not necessarily there in the listed space, and I'll give you three themes which are going to see a lot of capital movement within the private space. One is manufacturing. When I say manufacturing, it could be contract manufacturing, it could be defense, it could be infrastructure. All three areas will see a lot of private market investment. Healthcare as a sector, I mean, you will see far more spent towards healthcare per capita. You will see a lot of investments flowing towards the healthcare sector. And lastly, but not the least, consumer tech. And when I say consumer tech, the emerging area is also AI. I mean, right now, a lot of these companies are smaller and they're getting funded by, let's say, seed or Series A kind of funds. But eventually, as they grow bigger, you will also see a lot of private equity participation in these kind of themes. So a lot of the emerging themes which promise high growth and are going to build the next round of companies as India goes from $4 to $10 trillion will attract a lot of capital. The other thing is real assets, I mean, which includes, let's say, data centers, yield-bearing assets within commercial real estate or infra pre-REIT kind of allocations. You will see a lot of capital flowing in there as well. And we just spoke about private credit. That's another market which is very nascent in India, and I see it growing at 30-35% for the foreseeable future.
Right. You know, that's an interesting pocket that you're highlighting, but thank you so much, Ashish, for joining in. Always a pleasure to speak to you. Your commercial real estate spaces where a lot of other bets coming in as well when you talk from a REITs and InvITs perspective right now.